Question number 3. A, B, C and D were partners sharing profit and losses in the ratio of 3:2:3:2. Their balance sheet on the date of dissolution was as follows. A's capital under the liability side, A's capital 60,000, B's capital 30,000, reserve fund 24,000, creditors 36,000. Under the asset side, assets 1,02,000, C's capital 38,160, D's capital 9,840. The total of the balance sheet is 1,50,000. On the above date, C becomes insolvent and was able to contribute only 50 paise in the rupee. Assets realized 75,000. Realization expenses amounted to rupees 2,400. Make journal accounts. Okay, so in this problem, what is given? C is adjudicated as insolvent and he was able to contribute 50 paise for a rupee. Okay, if his due is 100, he was able to pay only 50 rupees. Okay, so only 50% he can settle. Okay, the balance 50% he was not able to settle. Okay, this is the point here. Okay, 50 paise per rupee means 50% of the amount he can settle. The balance 50% is he was not able to settle. Make necessary journal ledger accounts. This is realization account. Assets. Realization account. First we have to transfer the assets, that is 1,02,000. Second we have to transfer the liabilities by sundry creditors, 36,000. Then third step we have to realize the asset. The assets are realized at 75,000. Then sundry creditors are settled at rupees 36,000. Realization expenses that is given in the problem, that is 2,400. So the debit side of the realization account is 1,40,400. So from 1,40,400, if we deduct 75,000 and 36,000, we will get 29,400. In this problem, this firm faces loss, realization loss. Okay, that is 29,400. That has to be transferred to the partners' capital account in their profit sharing ratio. Their profit sharing ratio is 3:2:3:2. So if we calculate the loss or if we share the loss according to their profit sharing ratio, A's capital account should be debited to 8,820. B's capital account should be debited to 5,880. C's capital account should be debited to 8,820 and D's capital is debited to 5,880. Okay. Next step we have to prepare capital account. Balance. A's balance is 60,000. B's balance is 30,000. C and D has debit balance. Debit balance of 38,160 for C, 9,840 for D. But C is an insolvent. D is not an insolvent. Even though he has the debit balance, he is not declared as insolvent, but he has debit balance. Then we have to transfer the realization loss to all the partners. So A's realization share of realization loss is for 8,820, B is 5,880, C is 8,820 and D is 5,880. Then reserve fund is in the balance sheet. If we distribute the reserve fund, A will get a share of reserve fund is accumulated profit and so it should be credited to the partner's capital account. A will get 7,200, B will get 4,800, C's share is credited 7,200, D's share is credited 4,800. So reserve fund should be distributed to the partners according to their profit sharing ratio. Then the next one is the according to Garner versus Moray rule, solvent partner should bring cash for their realization loss. Here the solvent partner is only two partners, A and B. D doesn't have money. Okay, C is not a insolvent partner, but he has a debit balance. Okay, so A and B should bring cash equivalent to their realization loss. So by bank, that is cash account debtor to or bank account debtor to A's capital. So by bank, A brings 8,820, B brings 5,880. Okay. Then the next step, we have to find out the deficiency of an insolvent partner. Here the insolvent partner is C. C's debit side total is 46,980. From 46,980, if we deduct 7,200, that is reserve fund. Okay. Reserve fund is credited to the extent of 7,200 to his capital account. If we deduct, the deficiency is, the balance is 39,780. Okay. He is able to pay 50 paise per rupee. Okay. So, 39,780 into 50 percentage is 19,890. He can pay 19,890. Then the balance 19,890 is a deficiency of C. Okay, once again I explain. The total of debit side of capital account C is 46,980. From that 46,980, if we deduct 7,200, the balance amount is 39,780. 39,780 is the amount of the balance of C's account. Okay, he is able to pay 50 paise per rupee, and so if we divide it by 2 or 50 percentage, he paid 19,890. He was able to contribute 50 paise per rupee. So he was able to bring 19,890. The balance is 19,890. That is the deficiency of the insolvent partner C. We don't need to bother about D. Even though he has a debit balance, he is not considered, he is not declared as insolvent. So then the next step is, we have to calculate the then capital ratio of A and B. Okay, the then capital ratio of A and B is 60 plus 7,200 at the time of dissolution. The capital which is standing in the firm is called the then capital. Okay. Then we should not consider this realization loss while calculating the capital ratio of the existing partner for the purpose of the money which should be for the purpose of adjusting the deficiency of the insolvent partner. The entry would be solvent partner capital account debtor to insolvent partner. Okay. So that is the Garner versus Moray second rule. The deficiency of the insolvent partner should be shared by the solvent partner in their capital ratio. And so their capital ratio, while calculating the capital ratio, we should not consider the realization loss as well as the realization profit. Before the realization, what was their capital? Okay, that we have to consider. So reserve fund plus the balance is 67,200, and here the balance is 30,000, reserve is 4,800. So 67,200 is to 34,800. So if we simplify, the ratio would be 56:29. Okay. Then they have to they have to bear the deficiency of C. The deficiency of C is 19,890. So A has to bear 19,890 into 56 divided by 85, that is 13,104. B has to bear 19,890 into 29 by 85, that is 6,786. Okay. So the entry is already I told, solvent partner's capital account debtor to insolvent partner. So 2C is capital 13,104, 6,786. Here in the credit side, by A's capital, C's capital should be credited. By A's capital 13,104, by B's capital 6,786. So his account is closed. C's account is closed. And then let's see the D's position. D's position, the debit balance of D is 15,720. The reserve fund stands here is 4,800. If we deduct 4,800 from 15,720, the amount balance is, difference amount is 10,920. He is not declared as insolvent, so he can pay 10,920. Money recovered from, the amount recovered from D is 10,920 because he is not declared as insolvent. Okay, he has to bring 10,920 rupees. Then we closed both the C's account as well as D's account. And then now let's see the A's capital account and B's capital account. A's capital account total, the debit side, the credit side total is 76,020. So if we deduct from 76,020, 8,820, 13,104, the amount balance is 54,096 rupees. Then go to B. 40,680 is the total. Here the total, if we total, the amount is lesser than that of the 40,680. So we consider this amount 40,680. From 40,680, if we deduct 5,880 and 6,786, the balance is 28,014. That means A's capital account debtor to bank 54,096, B's capital account debtor 28,000 to cash or bank 28,014. A has to be settled by the firm 54,096. B gets from firm 28,000, not 28,014. Okay. In this way, this is the style to prepare capital account. So, first step, we have to transfer the realization loss, and then the next step, we have to follow the first rule of the Garner versus Murray. A solvent partner should bring the share of realization loss to the firm. Then we have to find out the deficiency of insolvent partner, and then the deficiency of insolvent partner should be shared between the solvent partner and in their then capital ratio. We have calculated the then capital ratio, and we have to close C's, that is the insolvent partners. Then let's see the solvent partners position. In this case, D has to be given. D has to give 10,920 rupees to the firm, and firm has to give to A 54,096, to B 28,014. Hope you understand this capital account. Then the last step, we have to prepare bank account. Assets realized 75,000. A brings 8,820 for realization loss. B's bring 5,880. C bring 19,890, 50%. He brings no. So that is 19,890. D, amount recovered from D is 10,920. So the total is 1,20,510. Out of that 1,20,510, creditors settled to the extent of 36,000. Realization expenses is 2,400. A's capital account is settled 54,096. B's capital account is settled 28,014. Naturally, the bank account is closed. Tallied 1,20,510, 1,20,510. Okay. So, I hope you all understand the concept of insolvency of partners. One or two partners are insolvent, we can apply Garner versus Morel. But if all the partners becomes insolvent, we cannot follow Garner versus Morel rule.